You know what's fascinating? While everyone's been obsessing over Bitcoin hitting new highs and gold breaking records, something extraordinary has been happening in the silver market. And I mean extraordinary in a way that could reshape the entire precious metals landscape over the next 12 months. Let me paint you a picture of what I discovered last week. I was reviewing the latest COMEX warehouse data, something I do every Monday morning with my coffee, and I had to double-check the numbers, then triple-check them, because what I was seeing didn't make sense. The registered silver available for delivery had dropped to levels we haven't seen since the 2011 squeeze. But here's the kicker. Back in 2011, everyone knew about it. The Hunt Brothers saga was still fresh in people's minds. Retail investors were lined up around the block at coin shops. This time, crickets. Mainstream media silence. And that's exactly what makes this so dangerous. The registered silver at COMEX warehouses sits at roughly 42 million ounces right now. Now, if you're not familiar with how this works, let me break it down in plain English. The COMEX has two categories of silver: eligible and registered. Eligible is silver that meets their standards but isn't available for delivery. Registered is silver that's actually available to fulfill futures contracts. It's the real deal, the stuff that matters when someone stands for delivery and says, "I want my silver." 42 million ounces sounds like a lot, right? Until you realize that global silver demand last year was 1.2 billion ounces. We're talking about COMEX having enough registered silver to cover about 13 days of global demand. 13 days. Let that sink in for a moment. But the shortage isn't just about the numbers in a warehouse. It's about what's driving those numbers down. And more importantly, who's driving them down. Because when you follow the money, when you really dig into the data, you start to see a pattern that's both fascinating and terrifying. Let's start with industrial demand. Silver isn't just a monetary metal anymore. It hasn't been for decades. It's the most conductive metal on Earth. Every solar panel uses about 20 grams of silver. Every electric vehicle uses between 25 to 50 grams, depending on the model. Your smartphone? About half a gram. Doesn't sound like much until you realize we're producing 1.4 billion smartphones every year. The solar industry alone is projected to consume 185 million ounces of silver this year. That's up from 140 million ounces just 3 years ago. And here's where it gets interesting. The Biden administration's Inflation Reduction Act, love it or hate it, has turbocharged solar installation in the United States. We're talking about a 40% increase in solar capacity additions year over year. Europe's doing the same thing with their Green Deal. China's building solar farms that you can see from space. Every single one of those panels needs silver. And unlike jewelry or coins, that silver isn't coming back. When you melt down a silver coin, you get your silver back. When silver goes into a solar panel, it's gone for 25 to 30 years. It's essentially removed from the supply chain. Now, let's talk about mining, because this is where the story gets really interesting. Silver production peaked in 2016 at about 900 million ounces. Since then, it's been declining. Not dramatically, but steadily. We're now producing about 830 million ounces annually from mining. Why the decline? Because silver is rarely mined as a primary product. About 70% of silver comes as a byproduct of mining other metals, primarily copper, lead, and zinc. When copper prices crashed in 2015 and 2016, a lot of mines shut down or scaled back operations. Those mines are still operating below capacity. And here's the thing about mining. You can't just flip a switch and increase production. It takes years to bring new capacity online. We're talking about exploration, permitting, construction, all of which takes 5 to 7 years minimum. I spoke with a mining executive last month, guy who runs operations in Peru, one of the largest silver-producing countries in the world. He told me something that stuck with me. He said, "We're not finding new deposits like we used to. The easy silver has been mined. What's left requires going deeper, processing lower-grade ore, dealing with more complex geology. It's more expensive, more time-consuming, and the returns aren't what they were 20 years ago. So we have declining production, surging industrial demand, and a COMEX warehouse that's being drained. But wait, there's more. Because the real story, the one that nobody's talking about, is what's happening in the investment space. You remember 2020 and 2021? When silver briefly touched $30 an ounce and everyone was talking about the Reddit squeeze? That was retail investors, mostly young people, trying to corner the market. It didn't work, not really, because they were fighting against the big banks and the futures market. But something changed after that. The smart money, the institutional players, they took notice. Silver ETFs have been accumulating metal steadily since mid-2023. The largest silver ETF, SLV, has added over 50 million ounces to its holdings in the past 18 months. That's more than the entire registered COMEX inventory. And it's not just SLV. There are dozens of silver ETFs around the world, all of them buying physical metal and locking it away in vaults. But here's where it gets really fascinating. Central banks, the same institutions that have been buying gold at record pace, are starting to look at silver differently. Now, they're not buying silver the way they buy gold. Central banks hold about 35,000 tons of gold in their reserves. Silver? Maybe a few 100 million ounces scattered across a handful of countries. But the conversation is changing. I got my hands on a research report from a major European bank last month. It was an internal document, not meant for public consumption, analyzing the potential for silver as a strategic reserve asset. The conclusion? Silver's industrial applications, combined with its monetary history, make it a unique hedge against both inflation and supply chain disruptions. They're not recommending purchases yet, but they're studying it. And when central banks start studying something, action usually follows within a few years. Now, let's talk about China. Because you can't talk about commodities without talking about China. The Chinese government has been accumulating silver quietly for years, not through official channels, not through their central bank, but through state-owned enterprises and strategic stockpiles. Best estimates put China's silver reserves at somewhere between 500 million and 1 billion ounces. Nobody knows for sure because they don't publish the data. Why would China want silver? 3 reasons. First, they're the world's largest producer of solar panels and electric vehicles. Securing silver supply means securing their industrial base. Second, silver is a monetary metal with thousands of years of history. In a world where the dollar's dominance is being questioned, having hard assets matters. Third, and this is pure speculation on my part, but I think they see silver as leverage. If they control a significant portion of global silver supply, they have influence over industries that depend on it. There's a historical parallel here that's worth exploring. Back in 1979 and 1980, the Hunt brothers tried to corner the silver market. They accumulated over 100 million ounces, driving the price from $6 to $50 in a matter of months. The exchange changed the rules, raised margin requirements, and the Hunts were forced to liquidate. Silver crashed back down to $10. But here's the difference between then and now. The Hunts were using leverage, buying futures contracts with borrowed money. When the exchange changed the rules, they couldn't meet the margin calls. Today's buyers, the ETFs, the institutions, the industrial users, they're buying physical metal with cash. There's no leverage to unwind. And more importantly, they're not trying to corner the market for profit. They're buying because they need it, or because they see it as a long-term store of value. The supply-demand fundamentals are completely different now, too. In 1980, silver was primarily a monetary metal. Industrial demand was minimal. Today, industrial demand accounts for about 60% of total silver consumption. That demand isn't going away. If anything, it's accelerating. Let me give you some specific numbers to illustrate the scale of what's happening. Global silver demand in 2024 was approximately 1.2 billion ounces. Total supply, including mining and recycling, was about 1 billion ounces. That's a deficit of 200 million ounces. Where did that 200 million ounces come from? Existing stockpiles, warehouses, ETF liquidations, jewelry being melted down. But here's the problem. Those stockpiles aren't infinite. The Silver Institute estimates that above-ground silver inventories, excluding jewelry and silverware, are around 2.5 billion ounces. Sounds like a lot, right? But remember, we're running a 200 million ounce annual deficit. At that rate, we'd exhaust available stockpiles in about 12 years. And that's assuming demand doesn't increase, which it absolutely will. The solar industry is projected to double its capacity by 2030. Electric vehicle production is expected to triple. 5G infrastructure, which uses significantly more silver than 4G, is being rolled out globally. Every one of these trends increases silver demand. Now, I want to take a quick detour here because this is important for anyone thinking about their financial future. If you're sitting on retirement savings, if you have $100,000 or more in a 401k or IRA, you might want to consider how precious metals fit into your portfolio. I put together a free guide on gold IRAs, how they work, how you can get physical gold into your retirement account without triggering taxes or penalties. It's in the description below. No obligation, just information. Worth checking out if you're concerned about inflation, currency devaluation, or just want to diversify beyond stocks and bonds. All right, back to the silver shortage. Let's talk about price for a moment. Because with all these supply constraints, with demand surging, you'd expect silver to be at all-time highs, right? But it's not. Silver is trading around $32 an ounce as of this recording. The all-time high was $49 back in 2011. So what gives? This is where the paper market comes in. The futures market, the derivatives, the financial engineering that allows banks and traders to create synthetic silver exposure without actually owning the metal. On any given day, the amount of silver traded on the COMEX futures market is 100 to 200 times the amount of physical silver available for delivery. Think about that. For every ounce of real silver, there are 100 to 200 paper claims on that silver. This works fine as long as everyone's playing the same game, as long as most futures contracts are settled in cash rather than physical delivery. But what happens when that changes? What happens when industrial users, or ETFs, or foreign governments start standing for delivery and size? We got a preview of this in March 2020. Remember the COVID panic? Silver prices briefly crashed to $12 an ounce. But here's what happened behind the scenes. Physical silver disappeared. Coin dealers sold out. Premiums on physical silver bars and coins went to 30%, 40%, even 50% over spot price. You couldn't buy physical silver at the paper price. The two markets completely disconnected. That disconnect lasted for months, and it revealed something important. The paper price and the physical price are not the same thing. The paper price is what traders are willing to pay for a contract that will probably be settled in cash. The physical price is what someone will pay for actual metal in their hand. Right now, we're seeing early signs of that disconnect happening again. Premiums on silver coins are elevated. Delivery times from mints are stretching out. Wholesalers are reporting tighter supply. It's not as dramatic as 2020, not yet, but the trend is there. And here's why I think this time is different. In 2020, the shortage was driven by panic buying from retail investors. It was emotional, it was temporary, and it resolved when people calmed down. This time, the shortage is structural. It's being driven by industrial demand that isn't going away, by investment demand from institutions that are buying and holding, and by a mining industry that can't increase production fast enough. Let me tell you about a conversation I had with a solar panel manufacturer in California. This company installs residential and commercial solar systems, thousands of panels a month. Their procurement manager told me they're now locking in silver supply contracts 2 years in advance. 2 years. That's unheard of in their industry. Normally, they buy silver on a quarterly basis, sometimes monthly. But they're so concerned about future availability that they're willing to pay a premium to secure supply years in advance. That's not speculation. That's not investment demand. That's a company that needs silver to operate, and they're worried they won't be able to get it. When industrial users start behaving like that, you know something fundamental has changed in the market. Now, let's talk about what this means for prices, because ultimately, that's what everyone wants to know. Where is silver going? I'm not going to give you a specific price target, because anyone who does is guessing. But I can tell you what the fundamentals suggest. If we continue running 200 million ounce annual deficits, if industrial demand continues growing at 5% to 7% per year, if investment demand picks up even modestly, we're looking at a situation where physical silver becomes genuinely scarce within the next few years. When that happens, when the market realizes that there isn't enough silver to meet demand at current prices, prices will have to rise. How much? Enough to do two things. First, to incentivize more mining production, which means prices probably need to be sustainably above $35 to $40 an ounce to make marginal projects economical. Second, to ration demand, to make some industrial users find substitutes or reduce consumption. But here's the thing about silver. It's very difficult to substitute. Yes, you can use copper in some electrical applications, but copper isn't as conductive. You can use aluminum in some cases, but it's not as efficient. For solar panels, for high-end electronics, for medical applications, silver is often the only option that works. So if you can't substitute, and you can't increase supply quickly, the only variable left is price. And price has to rise until it balances supply and demand. There's another factor that could accelerate this: monetary demand. Right now, silver is primarily an industrial metal with some investment demand. But silver has been money for 5,000 years. It's mentioned in the Bible, in ancient Chinese texts, in Roman records. For most of human history, silver was the common person's money, while gold was for kings and governments. If we see continued currency devaluation, if inflation remains persistent, if trust in fiat currencies continues to erode, silver could see a resurgence as monetary metal. Not as official currency, but as a store of value, as a hedge, as something tangible in a world of digital abstractions. The gold-to-silver ratio right now is about 84:1. That means it takes 84 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged around 60:1. In ancient Rome, it was 12:1. In the late 1800s, it was 16:1. Even in modern times, the ratio has spent most of the past 50 years between 40 and 60:1. If silver were to revert to a 60:1 ratio with gold at $2,800 an ounce, silver would be trading at $46. If it went to 50:1, we're looking at $56 silver. And if we saw a real monetary crisis, if silver reclaimed even a fraction of its historical monetary role, the ratio could compress much further. I'm not predicting that will happen. I'm just pointing out that the current ratio is historically extreme, and mean reversion is a powerful force in markets. Let me share one more story that I think illustrates where we are. In 2008, during the financial crisis, silver crashed from $20 to $9 in a matter of months. Everyone thought it was over, that silver was going back to being a forgotten industrial metal. But then something interesting happened. In 2009, silver started climbing. By 2011, it hit $49. Why? Because the Federal Reserve and other central banks started printing money on an unprecedented scale. Quantitative easing, zero interest rates, trillions of dollars created out of thin air. Investors looked at that and said, I need to own something real, something they can't print. Gold went from $800 to $1,900. Silver went from $9 to $49. It was one of the greatest bull markets in history for precious metals. Now, fast forward to today. We've had even more money printing than 2008. The Fed's balance sheet went from $4 trillion to $9 trillion. Government debt has exploded. We've had inflation that peaked at 9%, the highest in 40 years. And yet, silver is still trading below its 2011 highs. Why? Partly because the Fed raised interest rates aggressively in 2022 and 2023, which strengthened the dollar and made commodities less attractive. Partly because the stock market has been strong, giving investors other places to put their money. And partly because the silver story hasn't been told. People aren't paying attention. But the fundamentals are building. The supply deficit is real. The industrial demand is real. The declining mine production is real. And at some point, the market will wake up to this reality. When it does, when the mainstream financial media starts running stories about silver shortages, when CNBC has segments about COMEX inventory levels, when your neighbor starts asking you about buying silver, that's when you'll know the move has really started. But by then, you'll be paying significantly higher prices. The smart money, the people who understand commodity cycles, they're positioning now. They're buying physical silver. They're accumulating mining stocks. They're setting up for what could be a multi-year bull market. And here's the beautiful thing about silver. It's still accessible. Gold at $2,800 an ounce is out of reach for a lot of people. But silver at $32? You can buy a 1-ounce coin for $35 or $40, including premium. You can start with a few $100s and build a position over time. I'm not saying you should rush out and put your life savings into silver. That would be irresponsible. But if you're looking to diversify, if you're concerned about inflation, if you want exposure to a commodity with genuine supply constraints and growing demand, silver deserves serious consideration. The shortage is real. The fundamentals are compelling. And the best part? Almost nobody is talking about it yet. That's the opportunity. Because by the time everyone knows about it, by the time it's obvious, the easy money will have been made. So pay attention to the COMEX inventory numbers. Watch the ETF flows. Monitor industrial demand trends. And most importantly, think about what role silver might play in your own financial strategy. Because what's happening in the silver market right now, this quiet accumulation, this structural deficit, this growing awareness among industrial users and institutional investors, it's setting up for something significant. The shortage nobody's reporting? It's happening right now. The question is whether you'll recognize it before everyone else does.